Hello, good afternoon, everyone. We are Group C. Today, we will be explaining the case of AquaBright Ltd., a company known for its high-quality water filtration systems. So, in the recently, AquaBright has faced several significant events that require careful analysis under AASB 137, provisions, contingent liability, and contingent assets. So, these include product warranty obligations, environmental cleanup, a pending lawsuit, and a planned restructuring. In this case study, we will evaluate how each of these situations should be accounted for in the financial statements. Our goal is to apply the recognition, measurements, and disclosure requirements of AASB 137 to ensure that Aquabright presents a fair and compliant view of its financial obligations. So for Q1, today I would like to briefly explain how Aquabright Ltd. Should recognize and account for its product warranty provisions in line with AASB 137, provisions, contingent assets, and contingent liabilities. So let's begin with the recognition criteria. Under AASB 137, a provision must be recognized when first, there's a present legal or constructive obligation. Second, it is probable that an outflow of resources will be required to settle the obligation. And third, the obligation can be reliably estimated. So in AquaBright cases, the one-year warranty offers on its water filtration systems create a legal obligation. Historical data shows that 5% of units require repair or replacements. And with a known repair cost of $100 per unit, the obligation is both probable and measurable. Therefore, all three recognition criteria are satisfied. So moving to the measurements, AASB 137 recommends the expected value method when dealing with a large population of similar items. This applies here. For instance, if Aquabright sold 20,000 units during the year, at a 5% expected failure rate, 1,000 units are likely need to be repaired. At $100 per unit, the total provision amounts is $100,000. So this figure should be recognized in financial statements. So now the journal entry at the year ended will be like, we debit warranty expenses $100,000. We create a provision for warranty $100,000. This reflects the expected cost of fulfilling warranty obligations and align with the matching principles, ensuring the expenses are recorded in the same period as the related revenue. In conclusion, recognition and measurement warranty provisions correctly not only ensure compliance with AASB 137, but also enhance the credibility, accuracy, and transparency of Aquabright financial reporting. Thank you.
Hello everyone. My part is presenting focus on environmental liability faced by Aquabright and how it should be accounted for under AASB 137. So recently, Aquabright experienced an unintentional chemical discharge near the factory plants. So this incident triggered a likely legal obligation to perform a cleanup operation. So estimated the cost is around $500. So $500,000, sorry. According to AASB 137, we need to assess whether a provision should be recognized. So there's a three criteria under AASB 137 to recognize the provision. Number one, there must be a present obligation arising from the past events. Number two, it must be a proper that an outflow of resources will be required to settle application. And number three, which is the amounts must be reliably estimated. So in this case, the past events is a chemical spill. The application to clean up is legal, and it also, since Aquabright can estimate the cost at $500,000, this satisfy all three condition. Therefore, the company must recognize this liability as a provision, not merely a contingent liability, which means they must do it. So, yes, now we are talking about estimating the provision under ASB 137, the best estimate is the amount company will rationally pay to settle application. In making this estimated, Arkwright should consider the several factors. So number one, the natural and the level of the environmental damage. And number two, which is the legal advice on potential enforcement action and penalties. And number three, the expert cost of material, labor, and environmental services. And number three, which is number four is a discount ratio if the cleanup will be done or over time. And the number five, which is the last one, is any risky or uncertain things involved in the operation. Maybe someone gonna be hurt or the something gonna be wrong when it do the operation to clean up. Yes. So these inputs help arrive at both a supportable provision amount in the financial statements. In summary, due to the probable and the measurement application resulting from the pollution events, the Arkwright must recognize an environmental liability provision under ASB 137 and estimate the best costing using informed and risk adjusted assumptions. Yes, this is my part. Thank you.
Hello, everyone. Now I'll be covering how Arkwright should account for the pending litigation following the guidance in AASB 137. The company is currently facing a lawsuit from the competitor for patent infringement. According to the legal advice, there's a 60% chance that Arkwright will lose the case, and if that happens, they will likely need to pay $200,000 in damages. Under AASB 137, the situation is assessed against two key criteria. First, is the outflow of the resources probable? The answer is yes, because 60% is clearly more than 50% threshold. Second, can the amount be reliably estimated? Yes again. The legal team has provided a clear estimate of 200,000. Since both conditions are met, this is not just a contingent liability. It becomes a provision that must be recognized in the financial statements. And the journal entry at year-end would be debit for lawsuit expense 200,000, credit for litigation provision for 200,000. This ensures the company's financials accurately reflect the expected legal costs. Now let's look at how probability affects whether the company recognizes or discloses a legal obligation. ASB 137 sets a clear threshold. If the chance of an outflow is more than 50%, a provision must be recorded. On the opposite, the obligation is treated as a contingent liability, which is only disclosed in the notes. In this case, the 60% probability crosses the threshold, so recognition is required. But even when a provision is recorded, companies must still make key disclosures, such as a description of the lawsuit and the risks involved, the 200,000 estimate and how it is determined, and the expected timing of settlement. These disclosures ensure transparency and help stakeholders understand the legal exposure. So our recommendation is reassess the provision quarterly to reflect any changes in probability or amount. That's all for my part. Thank you.
Hello, everyone. My part will focus on the recognition of a provision during restructuring and necessary disclosures to be made in the financial statements under EASB 137. In this case study, Arkwright decided to restructure its operation due to a decline in demand for some of its product lines. During restructuring, the company has decided to make a severance payment of $300,000 to its affected employees. Under AASB 137, a restructuring provision can only be recognized when two main criteria are met. First, the company needs to have a detailed formal plan in place. And second, this plan must be communicated to those affected, in this case, which are employees. Once both are done, a constructive obligation is established, meaning that the company has committed to the restructuring and cannot realistically back out of the decision. In a corporate case, these conditions are clearly met. The plan was communicated to employees before year end, and the severance cost of $300,000 can be reliably estimated. So, this satisfies both the recognition and measurement requirements under AASB 137. The company must therefore recognize a provision of $300,000 severance payments in its financial statements. AASB 137 also requires some key disclosures to be made in the financial statements. The nature of the obligation, which is the product demand decline, expected timing, which is next financial year, the carrying amount, which is $300,000 severance payment, must be included in the financial statements of Aquabright. A few other disclosures include uncertainties and expected reimbursement due to restructuring, which are not provided in this case study, but if they were, they need to be included in the financial statements. To summarize, Aquabright meets the criteria for recognition of restructuring provision, and adding necessary disclosures helps ensure transparency of financial statements and compliance with AASB 137. Thank you.
Good afternoon, everyone. In this part of the presentation, I'll be discussing general provisions and contingent liabilities under AASB 137, as well as concluding our overall analysis of the Aquabright Company case study. According to AASB 137, for a provision to be recognized, three key criteria must be met. First, the company must have a present obligation resulting from a past event. Second, it must be probable that an outflow of resources will be required to settle the obligation. And third, a reliable estimate of the obligation can be made. In the case of Aquabright, each scenario we analyzed, such as warranty obligations, environmental liabilities, and restructuring costs, clearly meets all these recognition criteria. And for contingent liabilities, AASB 137 states that unless the possibility of an outflow is remote, the company must disclose certain information in the financial statements. This disclosures includes a brief description of the nature of the contingent liability, an estimate of its financial effect, an indication of uncertainties regarding the amount of timing or any outflow, and whether any reimbursement is expected. In Aquabright's pending litigation case, since the probability of lose is assessed at 60%, a provision is recognized. However, if the chance of lose were only possible, let's say 40 or less, then a disclosure would be required, not recognition. Okay. Now, for conclusion, this case study of Aquabright Company demonstrates how AASB 137 is applied in real-life business situations. By examining each event carefully, we have shown how to properly recognize, measure, and disclose provisions and contingent liabilities. The outcomes of this analysis are significant. Aquabright strengthens its financial integrity by recognizing obligation responsibly and reporting them with accuracy. Stakeholder transparency is also improved through detailed disclosures, particularly around litigation and environmental risk. Most importantly, by identifying potential outputs in advance, the company can better plan ahead and manage financial risk. So in conclusion, following AASB 137 not only ensures compliance, but also provides a solid foundation for future financial decision making and long-term strategic planning. And this is the list of the references. So we only used the AASB 137, so we only listed this one. Okay, this is the end of the presentation. Thank you.